This is John Prasinos, Editorial Director of Investing Daily, with a video presentation from Monday, May 17. To view our full range of products, visit our website at investingdaily.com. Stock market volatility has increased as conflicting economic data come to the fore, but after a brief sell-off last week, investors are bullish again. To quote the British World War II slogan, investors have decided to keep calm and carry on. This week, quarterly earnings from large bellwether retailers, as well as data from the housing sector, will test the strength of the stock market rally. The consensus is that the numbers will be positive. Last week, the panic started on May 12, when the government released data that showed inflation was hotter in April than expected. Take a look at the first chart. As you can see, inflation really spiked in April. After swooning Wednesday on the news, stocks jumped Thursday and Friday as optimistic investors shrugged off the hotter inflation data to focus on the benefits of economic reopening. The two-day rebound helped the markets claw back much of their weekly losses. Crude oil prices finished the week higher as the cyber-attacked Colonial Pipeline got back online. The pipeline operators reportedly paid $5 million in ransomware. A reminder that cybercrime is an omnipresent threat. After a few days of roller coaster action, stocks ended the week lower, but still in positive territory for the year. See the second chart. There's plenty of positive economic news to offset the negative headlines about higher prices and gas station lines. According to the International Monetary Fund's latest World Economic Outlook, the April edition, global growth as a whole will come in at about 6%. The global economy contracted by 4.4% in 2020, the worst decline since the Great Depression of the 1930s. Tailwinds for global growth in 2021 include greater vaccination rates, declining COVID infections, fiscal and monetary stimulus, high household savings rates combined with pent-up consumer demand, low interest rates, and easing lockdowns. The IMF projects that growth in the U.S. will exceed 6% in 2021. Chart number 3 breaks down the data for the Group of 7, the G7 economies. The quickening economic recovery is stoking inflation, but I'm not too worried because the economy is coming off a low year-over-year baseline. The U.S. economy shed 22 million jobs in March and April 2020, and it's still 8 million jobs short of where it was pre-pandemic. What's more, sputtering growth in a few sectors is mitigating risks that the U.S. economy will overheat. Notably, U.S. retail sales unexpectedly plateaued in April on a year-over-year basis, reaching $619.9 billion as the lift from government stimulus checks waned. The Commerce Department reported Friday a virtually unchanged reading in retail sales for April, following a 10.7% surge in March. The consensus of economists had called for an increase of 1%. The following chart depicts the numbers by segment. A pickup in retail sales is likely in the summer months as the pandemic fades and consumers dip into their substantial household savings. In a separate report from the Federal Reserve on Friday, manufacturing production rose a modest 0.4% in April on a year-over-year basis, in line with expectations after surging 3.1% in March. Total industrial production increased 0.7%. The indices for mining and utilities rose 0.7% and 2.6% respectively. I've beaten the infrastructure drum pretty loudly over the past few months, arguing that the entire world is gearing up for massive spending on public works. This investment theme will provide a multi-year tailwind for global economies and equities. You should increase your portfolio's exposure to economically sensitive equities and cyclical sectors, such as energy and financials, and pair your holdings in momentum stocks that have enjoyed a sharp and prolonged rise, e.g. in the technology sector. The market's current rotation from growth to value should continue this year. Well, that's it for now. If you want to reach me, I'm easy to reach. Just send an email to mailbag@investingdaily.com. Thanks for watching and see you next week.